Hi everyone, I'm Eric Sundheim with Mercovus Valuations. I'm pleased to be joined today with Mr. Tom Bondi, CPA. He's going to be talking with us about QSBS. Welcome, Tom.
Thanks, Eric. Pleased to be here.
So Tom shared a lot of information with me about taxes, and I thought this would be a great opportunity for him to share some of his wisdom with you. He's known in the Bay Area as the QSBS expert. So Tom, what is QSBS?
QSBS is Qualified Small Business Stock. You want to go into detail now a little bit?
Yeah, I've heard 1202. Is that the same thing?
That's Section 1202 of the Internal Revenue Code. That's exactly right. And that's the governing code section, if you will, for determining whether someone has stock that may or may not qualify.
Okay. Well, why would I want QSBS?
Good question. So here's the thing. If you have shares of stock in a qualifying C corporation, not S corporation, and you hold those shares for at least 5 years, and during substantially all that holding period, then the company, if the company continues to meet the qualifications of 1202, then you may be able to exclude the greater of 10 million or 10 times your basis in the sale of that stock upon a liquidity event.
Okay, so
That's a big deal.
They tell us when we're growing up, save your money, invest, but then you got to pay taxes. And you're telling me maybe I don't have to pay taxes.
You may not. And so the issue becomes, now California stopped utilizing Section 1202 back in 2013, but there are still some half of the states in the country that still do allow 1202. And there are shareholders and investors all over the country, so you never know which state necessarily it'll be taxed in. Because you recall, when you do leave a state and you go reside in another state, then capital gain is taxed in the state where you reside.
At least for now.
At least for now.
So at least federally, people who are investing in QSBS, their capital gains rate is probably 15 or 20%.
Mm-hmm.
We've got the net investment income tax,
Correct.
which I find a lot of people still don't know about.
That's correct.
Obama era tax of 3.8% on investment income.
Mm-hmm.
So we're saving at least federally up to 23.8%.
That's correct. Yeah.
And if we buy the stock when we're in California, but then we retire and move to Florida and sell the stock at that time, we're avoiding the state tax as well?
That's correct. You potentially still avoid the state tax.
Fantastic. So I'm interested. How do I get QSBS?
Yeah, good question. So first off, the stock must be originally issued by a domestic C corporation. So we'll just keep this really simple because there's lots of ways in which people err in this. But if I buy my shares originally from a domestic C corporation, and the company, at the time that I buy my shares, the company had total gross assets from a tax perspective of less than 50 million, then it's possible my shares qualify. And the reason I say it's possible is because there are other factors in Section 1202 that require the company to meet certain qualifications. For example, it's got to be a qualified trader business. It can't be an accounting firm, a law firm, services firm, brokerage, bank. It's not meant for service companies, although it does apply to many, many others. For example, people that own just a small store, for example, or any kind of a product, or potentially SaaS model company, technology company, pharmaceuticals types development, they may qualify. So you got to really look into seeing whether the trader business meets the qualifications.
Okay, so there's a couple criteria that I heard you just mention. One is that you and I are out of luck.
We're out of luck.
So no QSBS for us when we sell the business.
That's right.
Another criteria I heard was that it's got to be an original issuance. So if there's another angel investor and I get the stock from him, then it's not QSBS for me.
That's right. He may be able to, that selling shareholder may potentially be able to get 1202 benefits. But because I acquired my shares from that individual, that other shareholder, then my shares will never qualify.
Got it. And then we started talking about valuation criteria, which is near and dear to my heart. So Well, you said 50 million. We're offering valuations for these companies frequently for a number of purposes. Many times these companies need 409A valuations. So if I calculate within the 409A valuation that the company equity value is worth less than 50 million, that's not what we're talking about.
That's not what we're talking about. We're talking about gross assets of the company from a tax perspective. And so that has really, other than some other exceptions, it has nothing to do with valuation. It has everything to do with the gross tax assets. And that may be very different than the financial statement gross assets. So you have to, when you're looking at gross tax assets, and I'll give you a simple example. Since 2022, R&D expenses of companies, which used to be always expensed from an accounting perspective and tax, are now required to be capitalized and amortized. Okay. And so you may have on the financial statements nothing on the balance sheet because it was expensed in R&D, but from a tax perspective, it has to be capitalized. So you've got to be careful about looking at the companies and determining the gross assets. But generally, you're going to be able to take a snapshot and see what the balance sheet looks like. And if it's anywhere close to 50, then you're going to be suspect as to whether it qualifies or not.
Got it. And it's the assets after the investment. So if the firm were to receive 60 million, then it's no longer QSBS eligible. So.
Not true, no. So if I acquire my shares, and let's say the company had 20 million in total gross assets, and I acquire my shares, and then some months later the company raises, let's say, 40 million.
Okay.
And so now a couple things there. Number one, what does the balance sheet look like when I acquire my shares? Because even though they had already raised money, we're saying that the assets on the balance sheet were 20 million, right? And in my example.
Yep.
And so now I go raise 40, so the total assets bump up by 40 million, right? So now the company's at 60. So when the company crosses a threshold of 50 million in total gross assets, then only the shareholders of record prior to that time have the possibility of obtaining 1202 benefits.
Got it. And you told me about a neat trick for one of your clients that they should have taken advantage of. If maybe you're going to cross that threshold, you said maybe they could stage their investment.
That's right, yeah. And there are many situations where if a company is going to be raising some funds, if they sometimes just tranche the investments so that they come in over a period of time, months, so that maybe it's Series A1, Series A2, or Series B1, Series B2, they might be able to stay under that threshold for quite a long time. And I had one company, a venture group I worked with, they had put some 15 tranches of investments into a company through 4 funds. And had they just paid attention to one in 1 year, they probably could have picked up another 6-7 years of qualifying stock. So the companies, it's important for the companies to pay attention to this, and they often don't understand the benefits to not only the investors and founders, but to the new investors coming in.
Absolutely. When we see all the time, they think taxes are going to be a nice problem to have, but you're not in this game unless you're planning to pay taxes at some point.
Yeah, and you're talking about the ROI you can get, and so return on investment. So it's a valuable thing for founders, CFOs, general counsels to pay attention to. And unfortunately, most people in the country, let alone Silicon Valley, don't understand this provision, and they make incorrect assumptions all the time as to whether it qualifies.
Okay. And one of the other criteria that I know we've done valuations for is that there's this 80% rule. Can you tell us about that?
Yeah, that's a good question. The assets that are used in a traded business, it must be at least 80% of the total assets. So like I said, there are a variety of qualifications in Section 1202. One of them is that at least 80% of the assets need to be used in a trader business. So a good example is, and also that you can't have more than 10% of assets that are held for investment. So you have situations sometimes where a company raises a substantial amount of money, and then they maybe put it into investments because they don't need it right away. So there's a danger you've got to be careful about is how is that money being invested, so that you could still argue that 80% of the assets are used in a trade or business. But if we went and bought a building, let's say it was a 5-story building, and we use 1 floor for the business,
Okay.
and the other 4 floors we rented out, and that becomes a significant part because that's not used in the trade or business, those other 4 floors. So that alone could disqualify the company. Now, what's really important is that because there are, and we'll get into some of the other issues around 1202, but because the company does not meet certain qualifications of 1202 for some period of time, that does not mean that your stock does not qualify.
Okay.
Right? Remember, the definition is that during substantially all one's holding period, the company has to continue to meet the qualifications. So it's not just when you buy the stock, it's throughout your holding period, okay? And your holding period may be 6, 7, 8 years. It may not be just 4 or 5 years, right? And so, but if the company did not meet certain qualifications, for example, maybe they had some investments that took it over 10% for some period of time, okay, what period of time was that? And how material is that to all the overall qualifications of 1202 to determine that did the company substantially or not substantially meet the qualifications?
So there is some leeway.
It's a little bit of leeway, and just remember this: the burden of whether the shares qualify is not on the company; it's on the shareholder themselves. The problem is the shareholder doesn't really know all the facts.
Where are they going to get their information
And so
from?
they've got to be able to get information from the company, ideally. And the danger for the company is saying, hey, your shares qualify, when in fact they should not be giving that tax advice. All the company should be saying is the company did or did not meet these various qualifications of 1202, and it's up to you, shareholder, and your tax advisors to determine if you meet the qualifications. Primarily because there's a lot of reasons shares may not qualify at the individual level, but yet the company met all the qualifications.
Got it. So you don't want to take on that liability as a company to state whether or not this is QSBS.
It's a danger because if you have, let's say that you call up the company, you say, hey, do my shares qualify? And they say yes. Okay, well, what if you acquired shares in 4 or 5 different transactions? The company may be thinking these 1 block of shares qualify, and you may be thinking all my shares qualify, right?
Got it. That makes sense. And so I'm taking the rule for the asset threshold is they don't want you investing in some holding company that then invests in the stock market or some non-eligible business, and then you get the QSBS benefits for something this is intended to promote investment in small businesses.
In growing companies, it's to incentivize putting investments into companies to keep the growth going, right?
But the assets could be, we mentioned tangible assets like a building or cash, but they could be intangible assets as well. Right?
That's right. It could be intangible. It could be IP, other types of things that are actually used in the trade or business.
Okay.
Right.
So let's say we've worked with you. We've dotted all our I's, crossed all our T's. We're QSBS eligible. How much can we exclude in our savings?
Well, you can. This is an interesting thing about 1202. So the definition is the greater of, for a shareholder, the greater of 10 million or 10 times one's basis.
Okay.
Basis in this situation may not be tax basis, depending on how the share ownership of shares came about. Okay. But let's just assume for the moment that to keep it simple for the audience,
okay,
let's assume that I buy the stock at $1,000, and now it's worth 15 million. Okay, so how much can I exclude? Well, the greater of 10 times my basis, which is what, $10,000 or $10 million. Now it doesn't stop there, because we have other benefits that can come about, which we refer to such as stacking, where I might be able to gift some of my qualifying shares to irrevocable trust for my children, and each of those shareholders have the greater of 10 times basis or $10 million. Right?
Okay.
So that's called stacking. That could be a real benefit if you are fortunate enough to have a good liquidity event.
That makes sense. So if you're investing cash, it's pretty clear what your basis is, but you made me aware of this LLC conversion strategy.
Yes.
Can you tell us a little bit about that?
Yeah, and this is a lot of things I work on regularly these days for the last few years. Let's assume, in our example, it gets really complex, but let's just try to keep it simple. Let's assume that Eric and I have a partnership, and we've been putting money into it, but we've been spending that money, so we have losses. So from a tax perspective, our tax basis of the partnership is zero because we took all these losses.
Sure.
Okay? And now we're going to do what's called a conversion, which is putting that into a corporate form. It's a transfer, and for those of you who like to write down things, this is section 351. So we do a transfer in typical conversion into a C corporation, and so now we have to know what's the value that's going into that corporation.
And how do you know that?
We contact Eric and say, would you go do a valuation for us? Because we need a value of the business that's being the assets that are being transferred in. Okay, so let's assume in our example that the value of that business is $20 million.
Okay.
Okay, and we're going to go raise some money afterwards to get diluted, so it's worth $20 million. From Section 1202 purposes, because it was via that transfer, then the term basis applies to the 20 million. So now, folks, the maximum gain is the greater of 10 million per shareholder, or 10 times one's basis. Well, because our collective basis under 1202 is 20 million, the potential gain exclusion now becomes 200 million. So in a simple format, how does that work? Let's assume that that's all we have, and then down the road we hold these shares for more than 5 years, and we sell that stock, and let's just say it's sold for 300 million, okay? And we cashed out totally, to keep it simple. So the first 20 million is gain associated with the value of the partnership that converted over, okay? And you can't change that character.
Sure.
The next potentially 200 million might be 1202 gain.
Okay.
That's excluded from federal taxation in maybe some states. And then the gain above and beyond that would just be capital gain, subject to capital gains tax and net investment income tax.
Okay, so that's where all your hours are being spent.
That's where all the hours are being spent. There's a lot of activity in that area. But let's get a little more complex, because some of you may have an S corporation. Now you've got kind of a problem there, because when the S corporation, in the same scenario I just gave you, where the value was 20 million, we're trying to get to a C corp. Okay, now a couple of things there. If all we do is terminate the S election, those shares that we own will never qualify, because they were not originally issued by a C corp. Okay,
That makes sense.
so now we want to get to a C corp format. So how do we do that? Well, generally speaking, we would be transferring, just like in the partnership, we'd be transferring all those assets into a new C corporation. Okay, get a valuation. We already said it was 20 million. Now, we're not getting rid of the S corp. And the reason we can't get rid of the S corp is because, remember, I said that our tax basis was zero. So now if we have a business that's assets that are being transferred into a C corp, if we were to distribute those shares of stock out to the shareholders of the S corp and get rid of the S corp, that's considered a distribution.
Okay.
And now I've got a distribution of 20 million with no tax basis. I am going to pay tax on that 20 million because I got an asset worth 20 million distributed out. So in that situation, what happens is the S corp stays alive, and basically it has on the books investment in C corp of maybe $1 or whatever, $100, whatever the value, that's the base tax basis will be on the financial statements. And so now the S corp is holding shares of a C corp, and once that C corp stock down the road is eventually sold, assuming it continues to qualify, then that gain from the sale of that stock will flow through the S corp to the individual shareholders, and they'll have 1202 gain flow through.
Well, my head is spinning. Sounds like this is a very complex area, Tom, but I think we got a good overview. If you have more questions about this, please reach out to Mr. Tom Bondi, and appreciate your time.
Or contact Eric. He always knows how to get a hold of me.
All right, well, thanks so much, Tom. Appreciate it.
All right, thanks for joining us.